Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel Elconin, along with Brianna Valesky, and we have Henry Gambell on the line. He's the vice president at Simpler Options. Henry, how you been enjoying the markets over the last week?
Well, once you get used to the shift in volatility, it's great. It kind of came a little bit sooner than I thought it would, but making the adjustment to it's been good, and I've really enjoyed the swings of the past several days.
So with shifted volatility, and we talk about this on the show with with our traders and investors here alike, is that you should make some changes to your trading style, and because you're going to get bigger moves. One of the things, obviously, the easiest thing is to cut your size down. If you're a normal 1,000 share trader, maybe cut it down to 500, give yourself a little bit of wiggle room. You're pretty active in the options, so how do you adjust your trading style for more volatile times?
One of the biggest things is I think you have to shift from, buying, because typically I will focus on directional trading and buying options and participating in moves over the course of 3 or 4 days and sometimes a little bit longer. But when things start to get active like this and volatility really expands, well, you see the bid-ask spread widen out on a lot of your options. And rather than try to fight that and try to get a decent fill buying it, I would rather have good predetermined levels. And as things fall into those levels, try to take advantage of, like yesterday. Everybody chased everything to the downside into the end of the day. But, we had some big levels in Google. We had some big levels in the S&Ps. And if you're willing to sell puts into, very specific moves like that, that's the way that I really try to take advantage of it. That way, the next day gaps up, you don't necessarily have to have a huge run higher. You just kind of look for that air to come out of the balloon, so to speak. And that's how I just try to take advantage of those moves.
So you said you had some key levels in Google and the S&Ps. Could you tell us what those levels were and how you derived them?
Oh, sure. So we've got a couple different things that we use. One set of studies that we've developed with a couple other guys, it's just called the voodoo lines. And they're a derivative of Elliott wave, but it's just a little bit more automated, which I have found to be very helpful. And I combine that with basic fib work that I like to do, and that's how we came up with that 1900 level in the S&Ps. Of course, it doesn't hurt anything. You've got that big psychological level.
Yeah, there you go.
630 in Google was a level that we were watching, and you can see how it's been, falls right into it, traded right there at those lows during pretty much all of yesterday's session, even while the market was taking a severe beating. And then, of course, it, gapping back up above it today, that's been pretty helpful.
All right, so you sold some puts yesterday during that chaos, and it's a risky strategy. We should alert our traders and investors to that. So you weren't. One good thing about doing that, obviously you got to rip up here, 21 points in the S&Ps, and then you get the nice time decay. So would you look to cover the entire position or look to cover part of it? Because I know I have some friends with buddies that are trading options. Nick Shaheen we talked to, and when they sell something and it gets down to a couple pennies or a nickel or whatever, they'll gladly pay the commission and cover it, because what's the extent of how much more money can you make if it gets to a 3 or 4 cents. On the other hand, if things really turn around and go the other way, then obviously when you're short the option, you have a uncapped exposure against you.
Well, and one thing that I should clarify is that I don't do this stuff naked. I saw all of these puts as spreads. I'm not nearly brave enough to jump out there and, like you're saying, just to clarify that I'm definitely doing them as risk-defined strategies, because as much as I had confidence in those support levels yesterday, this market, you can link up to absolutely anything the next day. So I am doing all of them as spreads, but as far as taking profits on them, I think there's so much to be said. For me, if a spread gets down to 10 or 20 cents, if you're doing it 5 wide, I think it's a no-brainer to take it off. The way that I try to handle my positions, especially on a gap up like today, is just take half the position off right at the open, because, this is the move. This was the gap higher that we were looking for. Now, what happens from here? I think it's a lot harder to say. So what I like doing is taking half the position off when you get that opportunity, and then you can move your stops to break even, and it just makes managing the trade a lot easier. But, when a spread gets down into 5 and 10 cents, I think I think it's a mistake to leave it on and try to let it expire worthless, because if you close it out, first, of course, you eliminate the risk. Second, you free up the buying power, and you free up your mental capital. So you're not having to sit there and, what if the S&Ps are down 50 tomorrow? Well, then you'd feel kind of silly not having covered those when you had the opportunity.
Henry, I see that you run the chat room at Simpler Options along with some of the other moderators. Could you just give us take us back to last Monday here, and when you were in the chat room, what kind of responses you were getting from people, and just what were you keying on? Obviously, for me, I was looking at the S&P 500 futures, and then also looking at I really like to keep an eye on the top components because there was a point where Apple was $2 off the low of the day, and the SPOOs were at their low. What take us back to last Monday here, and give us a little bit of a peek of that chat room and what you were saying and how investors were reacting.
Well, I think and it depends. I think it depends on how long you've been trading as to how you react. Because if you've been doing it for a while, granted, that was a huge move, and I think even for some people it caught them off guard a little bit. But you're not a complete stranger to these big moves. So if you're accustomed to that, it's like, okay, we could navigate through it. People that were a little bit newer were definitely panicking, and I just try to be a voice of, whatever it is. If you're panicking, you should just probably step away from the computer. So once you kind of dissect who is really ready to trade this versus people that probably just need to, watch and kind of be patient, I switch over to a lot of futures trading in those environments because, like I said, the options, in that type of environment, I'm not trying to jump out there and sell puts in that case. I didn't do any of that on Monday morning. I was primarily focused on trading the futures, and that's where I'll, drop down and use things like the NYSE tick is a helpful reading of,
Okay.
Issues being bought and sold, and, just kind of back to basics, I guess I would say a little bit, in tape reading, watching the ticks, order flow, that sort of thing, and just trading the futures because I find them to be so much more liquid, so they're a lot easier to get into and out of. I mean, you had, even in the most liquid instruments, the spreads on the spider options were getting a little crazy too, and the thing about that too is it can change on a dime so quickly. So we were focused on trading futures, kind of trying to be very nimble with it. And then, as the week progressed and things got a little bit more calm, then we were able to work some option spreads a bit more efficiently.
Henry, we have just got back up to yesterday's intraday high. Yesterday's intraday high was 1939.50 here. We just had a quick sprint to 1941.75. We are now 42 handles above that low from yesterday here. Are you looking? I mean, you look at this as a potential shorting opportunity. Or are you just gonna try and take care of your positions from yesterday and move on?
Well, I don't think we are in a shorting opportunity just yet. And another thing that I try to remember in these environments is that emotions are extremely high. And whenever you get something like that, you're going to see more extreme moves to the up and to the downside. So obviously when things were, just falling apart yesterday, you can only imagine how many people got short that. I try to let as much of that kind of short covering and that squeeze go on, as I can. I think we can make our way back up into, looking at a daily chart here real quick, I mean, I think we could get back up into 2,000 in the S&Ps.
Really?
And then that's where I would, and of course, I am taking a day at a time, but I think if we got back up into 2,000, that would be just enough to kind of get people thinking, okay, we can buy the dips again, everything is back to normal and good, and I would be an aggressive seller of that level. You want to see how it actually gets up there, of course. If it's just ripping higher, of course, I'm not going to step in front of a freight train, but I just think there's so much psychology in this where people panic at the lows, you get all of them stopped out, and then once everyone's happy to buy the market again, then we can look to sell it.
Wow, I'll tell you right now, if we went back through those highs from Friday and Monday, that 1990 level, I mean, that would just, I don't want to, what term I can use to the fund managers and stuff, because they've raised a lot of cash here. That is definitely a scenario. The market likes to inflict the most amount of pain on the most amount of people. Back in the 2000s, I don't know, Henry. I think I'm taking the other side of that trade. I think you got too much resistance up here, and I think some of the big boys are going to wait to buy this market on a pullback, but that's what makes a market. Any other issues? You mentioned Google. You mentioned the S&P futures. Anything else on your radar today?
Another thing, too, and this isn't something that I focus on a lot. But with all this volatility too, I think it makes sense for some people to step into other products. Like I've started trading the grains a little bit now. Options on
Oh,
futures and
okay.
that are kind of a yeah, it's kind of a niche market, and I don't spend a lot of time doing it. But the thing that I like about that is it's a market that is usually not terribly concerned what the S&Ps are doing. It's not really relevant in the same way. So I like stepping over there where maybe you can find a chart pattern that is going to actually, flow out like you would expect it to. And you're not having to worry about, when the S&P's gap open 30 or 40 or whatever it may be, it having a big move. So that's another place I've been spending a little bit of time trading.
Yeah, which one? The beans or the
Uh,
wheat, or what have you been trading?
r- right now I'm looking at some October put options in corn.
Okay.
And and there again, I'm not, having huge size or anything like that, but I just think it makes a lot of sense to diversify and not feel like you have to be in the equities market because, maybe some people aren't looking for that much volatility. Well, trying to step over to these markets that are a bit more calm is one way to do it.
No, that's
And then,
yeah, that's it. What else? What else are you looking at today? How about crude? Have you been hopping into crude oil market?
last time we spoke, actually, we were looking at crude, and I think that's when it was back around 55 or so. So from that time when we spoke there into around 48 is when I caught the biggest part of that to the downside. I got out of it way too early, and I should have trailed it lower. I never thought it would have, gone as low as it did, just straight down, which is one reason why I think you always just kind of want to, let the market do what it will, and sometimes kind of get out of your own way. From the point right here, I think it's a tricky one to trade, and I would focus probably on just day trading it rather than swing trading it. I think you might get back up into 53 or so, but I don't think the bottom is in.
Yeah, a
It's a
lot of
little tough of
yeah,
a call, but
lot of
but
supply out there. Definitely a lot of supply. What about you
yeah,
looking at other commodities? Does gold ever catch your fancy?
I'm extremely interested in gold, but I'm interested to the short side, and it just hasn't been a short side trade for the past several weeks. The big thing, one of the biggest signals that I follow, and it's something that I learned from John Carter, who was my mentor going through all this, but gold is in a monthly squeeze, and if that squeeze does fire to the short side, I mean, the last time that it had the exact same signal, it drove it, I want to say, about $600 lower. So I think it's a very significant signal. And I also think it's interesting that there's just been no flight to quality to speak of there. You would expect, or at least if it was going to be a good, viable product, I would have expected to have seen it have some nice bounces on days that the S&Ps are so volatile. Honestly, it's just weird to me that it hasn't been moving any more than it has with as much volatility as you've seen. But I think if that daily chart can start breaking back down, I think that's another market you can look to play to the short side.
Henry, I'd love to jump in and get your take on a couple of hot issues this morning. Ambarella, we got earnings report. Of course, they make a component of the GoPro camera. Not sure if you follow this one at all, but do you have any take on Ambarella? That's AMBA.
This is where I think people sometimes kind of get, I don't know how to say it the right way, but sometimes you can overthink situations. So it's like, okay, what do you think about the company, about their long-term prospects, et cetera, et cetera? And I don't trade that way. I mean, I look at the chart, and that is a broken chart. So, obviously it's kind of easy to say this morning when it's down 10% on the back of earnings, but, I would look at that chart and I would try to find a spot to get short. I don't know that necessarily the drop this morning is a spot. And even as I look at it right now, I mean, the first thing that I would do if I was looking for a way to trade this is run a retracement from that big swing low that you made about a week ago into the high made 3 days ago. And if you can find, a 50 or a 618 retracement of that, usually that's a decent area of support that you could look to. And here again, not a strategy for everybody, but, jump in there and try to sell a put, because a lot of times you'll see, okay, it's down $8.20, but the expected move was $10. So when you see it stay inside that expected range, that's just where I would say either try to sell a put on it as the opportunity that I see right now, but then from a swing perspective, I would wait for a bounce and try to short it.
What about something like AT&T? Had a little bit of news this morning as well, caught an upgrade from an analyst. Have you followed this stock at all recently?
I really don't play AT&T too much, but, I'm hopefully it's not one of your favorite analysts or anything, but I do sometimes look at that stuff and laugh because, I look at the chart and I'm like, Is it just a blatant, obvious, hey, I really need to unload some of these shares, so let's upgrade this? I mean, that's how I feel about it. I just, it kind of goes back to where I don't follow those upgrades too much. I think to some degree you've got to look at them a little bit. But I go back to the chart and say the chart is telling me everything I need to know. So be it the upgrade or whatever it is, it's just rallied back into resistance, and it's already being dumped from the open. So it's not one that I trade a lot, but that's kind of the way I see it. And whenever I hear about upgrades and things like that, I always want to look at the chart before trying to make any assumptions around it.
Sure, absolutely. Well, why don't we take a quick look at one of biggest components in the market, Apple. Any thoughts on Apple? No recent news really, so I'm interested to get your technical thoughts.
I think Apple is another one that you've got to be very, very careful with, because it's kind of the one that, your parents own, the taxi driver owns, like everybody owns Apple, and it's like this big staple of the market. And I think the market's in trouble. We spoke about those levels in the S&P, and maybe we do fail from lower prices. I think Apple will be a good one to watch for that. As long as no Apple, no market kind of thing. And Apple is another that had a weekly squeeze that fired short, and it was kind of the precursor to this big down move. Maybe it trades a little bit sideways after making that big spike low, but I don't think it's something you want to own. If you do own it, I would definitely be selling calls against it. Other than that, I'm just, I would look for short-term opportunities to the downside. And I think it's another one of those tickers that you can look to, because there will be those days where the S&Ps have these big short covering rallies and it's up 20, 30 points, whatever it may be. I think coming over to Apple on days like that, looking for resistance and spots to sell calls, is the best way to trade it.
Henry, we've got about a minute left with here. Any final thoughts about the market for our traders and investors?
Well, for the past, I don't know, however many years it's been, I've been extremely bullish on the market, and I've been very adamant about trading it with the trend. What we've seen over the course of the past 2 weeks, I think, is finally enough to really, maybe shake this market in a big way. I think you've got to be careful where you pick your spots. So I'm not saying just jump out there and get, aggressively short every second you get it. But I think you really want to consider, long-term positions that you may be holding, and, pairing those off and looking at short exposure. So that's kind of the key thing that I'm going to be focusing on into the end of the year. And, if XLF takes out the highs, okay, then I'll scratch that idea and we'll go back to buying the market. But I think there's been some serious damage done, and it's going to take a lot to get this market back to a buy the dip mentality.
We've been on the line with Henry Gambell. He's the vice president at Simpler Options. Henry, thank you so much for joining us on the show. We would love to have you back.
All right. Thank you for having me.